Hi, good morning. Welcome to our webinar on forecasting for growth. This is my first webinar, but the fourth in our series brought to you by Smith & Williamson's Business Outsourcing Services team. So we'll get the exciting bit out of the way first, the disclaimer. But you all look like a good bunch of people, so I'm sure we're not going to have any problems there. Moving on, that's me. I'm Tom Edwards, Associate Director at Smith & Williamson. I'm a CIMA qualified accountant. I've worked in outsourced accounting for 7 or 8 years, but I have a keen interest in systems and using systems and technology to improve processes and helping clients get the best out of their financial solutions. Also a bit of a spreadsheet nerd, which is why forecasting and modelling is right up my street, and I enjoy that bit too. Smith & Williamson, across all our offices and our wider network through Nexia International, we are confident that we can cover all sorts of problems and requirements from a financial point of view. So we're in a pretty good place, and obviously being the 8th largest UK accountancy firm. So, quick agenda for today. We'll look at budgeting and forecasting, what's the difference and why both are needed. We'll look at why forecasting is important and the key elements to consider of when you're doing it, and we'll look at some examples of where we've helped some clients in the past. We will look at an integrated three-way forecast and why that is really the key element of having a true forecast that will give you the picture that you need. Then we'll get on to looking at some cloud tools and ways to help you build your forecast in a much cleaner, quicker way, and actually looks a bit crisper too from a presentation point of view. So first up, a budget, a static picture of where you want to go and how you want to get there, whether you build it from the bottom in a very granular way and get it to your end result, or whether you have a clear picture of what you want your business to look like in 12 months and work your way back. This typically won't move. It'll be drawn up at the start of the year or just before, and it'll just be there as a guide of where your end goal should be. On the other hand, a forecast is a constantly changing picture of the future based on actual events. It's a prediction of what will happen if your current events continue. So then it'll show you what you need to do to be able to pull back to your desired outcome. Recently read a blog by a company called Futurely, which is one of the systems we'll look at later in the webinar. They had quite a good analogy for budgeting and the forecast. They said that budgeting is the route map and the roadmap that however many years ago we would have printed off from AA and our CD-ROM, or now if we were to print off a route from Google Maps. Whereas your forecast is your sat-nav. So in theory, they both take you to the same place, but your sat-nav will make up for any differences, any issues that come up, any wrong turns that you take, and it will help bring you back on track to where you want to be going. Why is forecasting important? So when you look at your accounts and you look at your P&L and your balance sheet, all you're doing is looking at what you've done, admiring your successes, thinking back about what's gone wrong and why, but you're missing the opportunity of looking ahead, seeing what opportunities are coming up, making sure that you avoid any pitfalls or problems that might happen. So if you just look at those backwards-facing accounts, you're not giving yourself any help at all to take the opportunities that present themselves. Forecast enables you to predict what your business will look like. You can build your forecast initially to get your framework and see where that's going to take you, but that gives you the opportunity to adjust it and tweak it to where it is that you want to go. Without a forecast, you won't get that opportunity to make those changes. It will provide a business case for any significant business decisions that you make. If you want to take on a new contract, you want to move into a different country, you want to move into a different service or sector, having a forecast means that you can model what that decision might be, what the implications are, what the costs might look like, and eventually what your business will look like off the back of that. So typically any key decision you make will be backed up by what your forecast suggests will happen. That therefore means it allows you to react very quickly to any new opportunities without wasting time trying to figure out if it's possible or whether it will make you any money or whether it will make you stop trading as a business. You've already got that in place and you can take those opportunities. It also allows you to be proactive. It allows you to take the necessary steps to avoid any mistakes you've made before. We're all told from a very early age to learn from your mistakes. If you can't see where your business is going, you can't see where those mistakes might come back. So you can't put in the structure to avoid making it for a second, third, fourth time. All of this is great, but the key bit is to be realistic. If you're going to build a forecast that is completely unrealistic and suggests you're going to quadruple your turnover in a month, that's almost never going to happen, in which case all that time spent building it has been pointless and irrelevant. A forecast needs to be realistic to give you a good idea of what your business will look like so that you can make the right decisions to make sure you get there and beyond. Real life examples where we've helped people in the past. So profit doesn't equal cash. If your accounts are showing a profit, that doesn't mean the money is necessarily there to spend in the short term. Looking at your accounts in isolation won't take into account any assets or liabilities on your balance sheet. You may have recognised the income from your sales invoices, but they might just be sat in debtors, which means the money isn't there for you to spend. Similarly, cash in the bank doesn't mean your business is profitable. You may have loads of cash in your bank because all your sales invoices and your debtors are being paid up, but you need to be aware of what your supplier payments are and when that has to be paid to get a clear picture of what your future cash balance will be and therefore your profitability. One client I've had in the past constantly go on about how there's cash in the bank and why aren't I making profit? Now, partly this is an issue of him just not understanding his accounts and how the accruals process works. But when it comes to forecasting, you really have to bear this in mind so that when you forecast your cash appropriately, you're not just forecasting profit. Make or break point. So by make or break point, I mean a point where things are tight, cash is a struggle, and you're trying to juggle things almost on a daily basis. We've had a client here in the past who's in a difficult position, just paying invoices on a daily basis, whatever they had in the bank. Whoever called most recently or was shouting loudest, they just pay. They weren't taking any account of supply payments coming up, the VAT return due in a quarter, and how that was going to be afforded. With a good detailed cash flow, it allows you to see what's coming up in the short term, where those pinch points are, and allows you to do something about it. We were able to identify the points in time when we needed to have a big push and concerted effort on chasing up debtors ahead of low cash positions. It also allowed us to look ahead and see where we weren't even able to make that payment. This enabled us to have a conversation with the supplier ahead of the due date, explain our situation in an open way, and what processes we were going through to make this up to a point where everything would be paid. If necessary, we were able to agree a payment plan with the supplier to make sure that they were happy with how that debt would be cleared. As a result of this, all the creditors would be able to be paid in full without further cash injection, but it also meant we were able to maintain a strong relationship with our suppliers instead of just not paying them when their invoices fell due. Because by giving them the forewarning, they could then adjust their own forecast and their own cash flow accordingly, and they could manage their business effectively. So forecasting isn't just about being able to see where it all goes wrong. A good forecast shows you the point in time when your business is ready for that next growth step and when that further investment is required. A good forecast can show you how much you need in terms of investment, when you'll need it, but also how much you can afford to pay back and when you can pay it back. This means that, again, you can take those opportunities as they arise instead of just scrabbling around trying to understand whether something's feasible, short period of time, and before you know it, the opportunity's passed and you've missed out. We've had lots of clients in the past build and maintain models and forecasts, which means they can view their business so that when the time does come for investment, they were all ready to go, there's no panic, no rush, and they had all the answers to the questions that they were asked. So, my integrated three-way forecast. This is where your forecast has to take into account your balance sheet and your cash flow and your profit and loss, and it all has to link together. Thinking about all those examples we just went through, They all point to the fact you can't just consider one element of your forecast to make your business decisions. Example 1, profit and cash, talks about needing your P&L and balance sheet together to get a complete view of your cash flow. Example 2 talks about understanding your profit and loss properly and your future costs to be able to get a detailed cash flow forecast. Example 3, planning for a future, shows that any investor or bank or individual will want a full working model with your balance sheet, P&L and cash flow all in there together before they even entertain the thought of investing in your business. By building a dynamic forecast that integrates all of these together, where they all drive from each other, means that you can have a complete view of what your business looks like. If you don't like what it looks like, do something about it, or you can change your expectation of what success should be. But if you don't have that, you can't make those decisions. Now, typically, I would have jumped straight to a spreadsheet to build my forecast or my model. But to get a forecast working really well, so it crosscasts together and sums up and summarises it all, so that you're not having to put in every finer detail on each part of your forecast, you end up having an enormous workbook with huge, complicated functions and formula in it that for anyone else other than the person who built it can be quite complicated. Now, as I say, I'm a bit of a spreadsheet nerd, and nothing gives me more joy than coming up with a new formula and making something work in a bit of a slicker way. But if I was to pass that to someone else, to one of my colleagues who doesn't quite understand Excel to the same level, if changes are made or required to be made, it can be difficult for someone else to understand where it needs to go, what box needs to change. Do they just type over a formula and that's it? And then that can cause disastrous events further down where you just can't see that a formula is being typed over. It also becomes a task when you have sent that to an investor. They spend half the time reviewing it and trying to chase around all these formulas around your workbook, trying to find where the source data comes from. So it can be quite a long-winded and laborious task. The alternative, therefore, is to utilise cloud technology. Now, there are cloud forecasting tools that we use at Smith & Williamson, Futurely and Spotlight Reporting. We work with both. They're very similar in terms of what you can get out of it, but there are slight differences, so we would tweak it to the client, who they were, what they wanted, what industry they were in, etc. But what it gives you is the ability to build a quick three-way forecast that is so simple to change and adapt, and you can copy between forecasts. So very simply, you have one budget, and in very simple steps, you could then have a forecast based on your budget, but that's been updated with actuals, and you can then copy again and start looking into scenario planning, where you're looking at your best case and your worst case and your most realistic case to give you that feel of how risky your business option will be and whether you can survive through it. So obviously, if you can prepare for the worst and your business can still survive and it's still a profitable decision to make, then you can calculate that risk associated with any business decision. So I'm going to take you through a quick demo of setting up a forecast within one of our systems, Futurely, that we like to work with. So Futurely is a reporting package which can do all of your forecasting, and it also provides you with a dashboard type solution, so you can see your current results and KPIs in an easy graphical format. But from a forecasting point of view, there's 4 easy ways of building your forecast. You can either create from scratch, which is literally just typing numbers into your spreadsheet. You can create from a CSV import, so perhaps you've built a budget already and you don't want to build it again, and you don't want to rewrite it all for your forecast. You can actually import that budget into Futurely and use that as your base. You can create a copy, as I say, particularly with scenario planning, where you want to take it on or add in an opportunity, you don't want to lose your original. You can just copy a forecast that is already there and make some tweaks and then compare between the two. What we're going to do today is where it's created based on your actuals from last year. So it takes the run rate and it extrapolates it forward and effectively shows you what your business will look like based on what has already happened. So we're going to build one from today. And we simply, one screen to get it all set up and started. We have our name, We can select the duration, depending how long you want to do it for, and then you have your start date for when you want it all to start, taking your actuals up to and then forecasting your figures forward. This bit at the bottom allows you to assume a fixed growth rate, either globally across everything or in your individual categories. So quite simply, you can either do an amount, I want to increase my income by £10,000, or you can do it as a percentage. So today, we will look at increasing our income by 10%. That's our VAT percentage. The periods ago column is basically which period you want to compare to. So I will look at November last year and grow it by 10%. I could change that to 3 periods and it will look at 3 periods ago and change that by 10%. So if we do cost of sales will increase by 3% and expenses will increase by 1%. This tick box at the bottom basically means it will either generate a fixed forecast based on what you've put in these boxes and spit it out, or if you tick that box, it will be based on formulas so that you can update it and tweak it and add things in. It says it takes a bit longer, it does take a huge amount longer, but it's completely worth it in the long run. So as I click build and we watch these numbers whir around the system and whir around the screen, think back to how long it takes you to build that forecast initially and your budget and get it all set up and looking at those figures in the past. Think how long it takes you to do that first step. As you see, the numbers drop into this screen, already calculated, already increased by those percentages that we wanted to increase it by, into a clear format that we can see and that we can work with. In a matter of seconds, everything comes in as we'd expect. For those of you that like a bit of a colourful graphical representation, you can look at your key cost and income lines and show how that will look going forward. So, we have a workings tab, which is where you put in all your figures and your calculations, and it's so simple to increase what's in there. So if you did have that decision of do I take that new client or not, we can drill down. Say I've got a new contract to produce new batch of posters over a fixed period of time for a university. I can simply open up my new entry. There's a number of different ways to add an entry in, whether it's a repeating entry or a one-off. You can just add it in and it will repeat it for as long as you want it to. You could set a monthly growth rate. On the fly basically means you type in the number in the box where you want it to go. Bit more laborious, but if it's one-off projects perhaps, that's probably a quicker way of doing it. And the formula method, which is actually really slick, especially when you're putting in extra expenses. So we'll have a look at that shortly. So for my income, I'm going to do a repeating entry. I know I'm going to get £2,000 per month, a lot of posters, 20% VAT starting from the 1st of November. It's a monthly repeat, and it'll repeat every month forever. You can end it if you wanted to. If it was only a 12-month contract, I could end that after 12 months. But in this instance, it's going to be rolling going on until I want to stop it. This part at the bottom, this is where the integrated three-way bit really comes into play. It's a single payment, but I know I'm not going to get paid for 30 days. What that 30 days does, if we look at the journal here of what's going to be created, the 1st of November when I said my contract starts, I'm going to recognise my income of my £2,000. I'm going to recognise my VAT liability in the same period. And I'm going to create a debtor because I know I'm not getting paid straight away. Then automatically, in 30 days from now, Futurely will put in another entry, which is effectively the receipt coming into the bank and then my credit against my debtor to net that off. So I don't have to do 2 steps for that payment. It all just comes in just by adding in those debtor days. So I save those changes and the forecast will automatically update and drop in that new contract that I put in and that new level of income. In terms of adding in the cost, while that's thinking and loading through, and it comes through there, you can see my £2,000 a month. In terms terms of cost, and where we look at this this formula method, I know for every poster that I make, it's going to cost me a fixed amount, fixed percentage of ink costs. So when I go into my ink costs, my formula method, in this box you can tag any item from your model. So I could look at poster sales, and I could say for all of my poster sales, my ink costs will be 0.1% of my poster. Sorry, that's too many zeros. 0.01. That way, when it comes through, it will automatically link to your poster sales income line. So if you have another contract with poster sales and you put in another line, your ink costs will automatically update because it's linked to that total poster sales. So I don't then have to go back and add in more ink costs because it's set up using that formula. And that formula will always update for what's in there based on the category that I've tagged further up ahead. Same thing applies in the balance sheet, and you can just drill down and you can see everything that's in there and add bits in as you need. So fixed assets, if I need to buy a new printing press, I could put in my new fixed asset and when I think it's going to happen and when I think I'm going to pay for it. And that all pulls through to your tabs, your balance sheet, your profit and loss, and your cash flow based on what is in your workings. So in the space of, 5 minutes, we've been able to build a model based on my actuals, put in a new contract, and get an output that fully integrates and fully updates as you work along. So, using something like Future in Spotlight, yes, it speeds it up, and yes, it gives you a much quicker and slicker way of building it. But if you think, within the cloud ecosystem, there are all these different types of system and app that all talk together. So if you think you have your Futurely system for your reporting and your forecasting, you have a Xero or QuickBooks behind that as your accounting system, which has automatic bank feeds pulling straight in from your bank every day. You then might have someone like Receipt Bank or Auto Entry, which scans in your invoices as and when they turn up and reconciles it in Xero with the entry from the bank. That will all automatically pull through to Futurely and give you almost completely real-time forecast with real-time actuals in it and how it will look based on everything up to that day. That's a pretty powerful tool if you can get that set up right, because the time it takes to add actuals into your spreadsheet, and if you remember to do it and when you have time to fit it in, it all takes time. But if you set up your cloud ecosystem effectively, it'll do it for you. And that's before you look at things like expenses and Chaser, which is a debtor credit control-based system, Workflow Maps, which is an approval-based system. They're all there to help you get this into one slick system. I'm not going to talk too long on the whole cloud technology bit. We've done some webinars in the past based around the cloud system and how to build it and what's good. So you can look on our website or drop me a note in the Q&A and I can forward you links to those afterwards. So, wrapping up. Look forward, not back. Make sure you're looking ahead and you see those opportunities of what you can take, and you take those opportunities and you sidestep all those pitfalls. Be realistic. It's great to have a dream of where you want to go. To quote Chris Coleman, don't be afraid to dream. But from a forecasting point of view, you have to be realistic. You have to make sure that what you're basing your business on is justifiable. It's not just you, it's your business's suppliers and staff. So if you have a wild forecast and you're making crazy decisions off the back of it, you're putting a lot of people at risk. So have your dream forecast, have your one that says you're going to take over the world, but also have a realistic one or a worst case scenario one. And if you can still do it on that, you're in a very good position. Three-way forecast, bringing everything together, it takes into account all of the elements of your financials to make sure you're not missing any key information. Utilize cloud technology as much as you can. It's not for everybody. There's a lot of resistance to it in terms of it all being online and security and all of that. But look, these companies have spent millions of pounds developing highly secure system, as secure as bank systems, online bank systems and mobile banking apps. There's no difference, but they spend millions making it such a way that it's so easy and quick to use. It seems a shame not to take advantage of it in some way as much as you can. Finally, speak to Smith & Williamson. We're here to help. We clearly believe in these systems and we enjoy working in it, and we enjoy helping businesses get a much better way of getting the information out of their system and using it in the most efficient way possible. So we'll take a few questions. I know there's been some questions that have come through. Someone has asked, which accounting platforms does Futrli link with? Now, as I say, Futrli can link automatically with systems that are based on the cloud like Xero, QuickBooks Online and Sage, but it also allows you to import data into it. It allows you to take any sort of data from your system into a spreadsheet and upload that into Futrli. So it can still work. It's not as slick and real time, but it does still work, and it does still allow you to get that quick forecast building functionality out of it. Probably one more question before I get booted out is, I currently forecast my cash on a spreadsheet that I update every week for my own business. What do cloud systems bring that I don't already get from Excel? Yeah, look, if you already forecast in a spreadsheet and it works and it doesn't take up too much of your time, there's no reason to move on to a cloud system. If it's in a comfortable place for you and you're updating it and using it effectively, there's no reason to change. But if you find you're spending ages consolidating these spreadsheets and updating it, perhaps looking at something on the cloud is a useful way to take a step back, cut through all the noise, look at what it is that you actually need to see out of it. Again, I love spreadsheets and I will always love spreadsheets, but cloud forecasting does a lot of that legwork for you and it is very easy to use. But the key from this webinar isn't the cloud, it's forecasting. And if you're happy forecasting on a spreadsheet, carry on doing it. There's always stuff, it will always be possible in a spreadsheet. You've obviously got your risks, but the key is it's comfortable for you and you're in a process and you're happy to keep working on that. You've got my contact details there. We're pretty much at the end. Please get in touch. I'll respond to all the other questions that we've had after the webinar. Thanks a lot for taking the time out of your day to listen to me ramble on about spreadsheets and forecasting in the cloud. Hopefully, I look forward to seeing you for our next webinar, so keep an eye out for that. But thanks a lot. Have a good rest of the day and have a good weekend. Thank you.